Were you aware that your children's financial habits are pretty well set by the time they're 7 years old? If not, that was a big shock to me as well. And something that has rattled me a little bit because I have a 7 year old and I want to make sure that she is setting herself up for financial success, but also using me as a guide to help her get to that point. And this is something that, again, should shock you a little bit, but also I think it gives us an opportunity to have a conversation, a productive conversation around how to help your children financially both understand money and then some ways to actually save and help that child understand what investing is all about. So, why is it so important to start early? And what should you be doing as a parent? And if, let's say, you have kids older than 7, you should be continually having the conversation. And if you feel like you're a little bit late to the party, there is still time to have this conversation. But there was a report that was created in 2018 by Purdue University looking at children's financial habits and how they create those financial habits. And they identified that children around 3 years old have an understanding of what money is. And I think what I've seen as a parent of a 7, 5, and 3 year old is that children start to understand that there's a connection between providing value and things that you're exchanging. And as parents, we have to give our children a lot of credit because they are smart individuals and they can pick up on things. So when we're swiping our credit cards, we are looking in our shopping habits and how many Amazon boxes, all of those things start to understand how money is connected to the bigger picture. But then by 7 years old, many of our financial habits are actually set. Now, they're not set in stone because I can even see financial habits that I have been able to shape, change, and cultivate over the years. But I think the point is that those financial habits have a huge driver of financial success or failure later on in life, and they can have a huge impact on how you look at the world. So I think as a parent of three, it's really important to understand and help my children set boundaries, but also understand how money's earned, how money's spent, how you can invest. And a lot of clients come to me and a lot of people in my community ask me, what should I be doing to help my children both invest and understand money? And this comes in a couple of different ways. It's, in some cases, it's a little bit self serving in the sense that they want to pay for part of college or all of college. What's the best avenue for that? We are a generation as millennials and young Gen X that we're straddled and saddled with a lot of debt when it comes to college expenses. And a lot of people, I think, feel a little duped by that system. And so I think we're seeing a little bit of a generational shift here that A, college has gotten really expensive, and B, we are a generation that paid for a lot of that education by way of taking out student loans. So I think that there's a little bit of a shift in the conversation to help our children set themselves up and then by way of that set ourselves up for their success by doing that through a smart means. So the first thing that I look at is what's called a UGMA or UTMA, and it's a unified gift to minors account. And what that is basically it's a custodial type of account that you can have for a child. And what I really like about these accounts is that they provide a lot of flexibility. There's no hard stop or hard ceiling on how much you can contribute to those accounts. There are some gift tax considerations that you have to think about or some gifting limits, but for the most part, they're not, you don't need any tax breaks for making contributions to those. And so therefore there's just not a lot of strings attached. So it's a lot like a brokerage account that a parent might have. And you can have the money invested in a money market, very simple, basically a cash account that's earning a little bit better interest than maybe a regular savings or checking. You can also invest into different assets like stocks and bonds and other things, gold, commodities, different investments. And that's really nice because what I've done with my children and the conversations that I've had around using one of these unified gift to minor accounts, they allow us to have conversations around investing because we can actually buy an investment, buy a stock as an example, if the child's really into Nike as an example. So we can actually, share with the child that we're actually buying a share of this company. So we can really understand this idea around ownership versus lending, which is a very big discrepancy and a big financial topic that we talk about with adults when it comes to bonds and stocks. What's the difference between a bond and a stock? So again, you can start that real world conversation around how to invest. What are you investing? Why would you invest in this particular brand or not? I think about Apple as a great idea or a great company for a lot of young people, whether that's the iPhone or the AirPods or the next technology thing that they have. So you can really connect a product to a company to an investment. It's really kind of a fun way. One of the downsides to a UGMA account is that it actually becomes the child's money at the age of majority. So in Colorado, that's going to be age 21. And it could have an impact potentially on financial aid. That's certainly an issue that I've seen with some clients when it comes to getting student loans and things like that, because it's actually the child's account and the child's money. If a child shows up on their FAFSA or some other needs-based type of scholarship, that might disqualify them from that particular benefit just because they don't like to see a child have specific assets. And an UGMA account would fall into that as a child's specific asset. So that's one of the cons. It becoming the child's at 21 with no strings attached can also be a little bit of a challenge. In fact, I have a client whose son recently turned 21, and it just so happened that she had funded an UGMA account. Son was going to study abroad in Europe. And she asked me kindly that maybe we could hold off to actually let him know about that account until he's back from his study abroad. And just the way that things worked out, we were able to do that. But she was a little freaked out that all of a sudden the doors were going to come open and this kid was going to have this money at the most inopportune time. But if you've done your steps, you've done your diligence as a parent, you'd let them know kind of what's going on, how this might affect them. So certainly one of those things that comes with the con is that you can actually set this up for success. And then the last part is that at 21, when it becomes the child's, the parental oversight and control ends. So you now no longer have that control. It is the child's, it's there, it's not to be touched. Another thing that we look at is going to be a 529 college savings plan. Another great way to set a child up for college success. One of the things that we look at with that is that if you think that your child's going to be college bound or even just a trade school, they can be a great vehicle to set that child up and pre-fund and prepay effectively through an account those expenses. So a 529 is a really cool account because it's like a Roth IRA in a lot of ways, in that you get a tax benefit on the front end. Now, it is going to be a state-specific tax. So certain states like New York and California, you don't get any income benefit, but the account still grows tax deferred. So let's say you add $1,000 and it grows to 2,000. That growth is tax deferred. And then distributions, and this is the universal rule, is that the distributions are going to come out tax free. So while you may not get a wonderful benefit on the front end, if you have the opportunity for growth over a long period, that can be a really beneficial thing. The nice thing is that another pro of having these 529s is that it is earmarked for a very specific need. And so when I use a 529 or help clients build out their 529 planning, it really fits inside this mold of this goals-based approach that we use at 4 Points Wealth, because it's very specific, it's very intentional, it's very mindful. I was working with a client recently. They had a bit of a windfall and they wanted to create a really strong foundation for their elementary age children for their 529s. So we talked through what their ultimate strategy is, and we found a good number that would fit into their financial plan that we can then set them up for success down the road, not only for the child, but for the parents as well. Another nice thing about the 529s is that they are very transferable, meaning they can be transferred from one child to the next. They can actually be transferred to like a cousin. Their portability is very lenient, so long as you're doing it by the right way to do that. And that can be a really great benefit for a lot of families, because it does give them that flexibility if the child doesn't need it, whether they get a scholarship or some other thing. The other thing that I also like is that the things that you can use for the 529, they are generally pretty lenient for what you can spend those dollars on. So for example, obviously tuition, books, things like that, but you could also do a dorm. You can fund other school related expenses if the child needed a specific computer for that. So again, you've got a little bit of flexibility on how those dollars can be spent, but as long as they are considered to be for higher education or for an educational expense, you can use those dollars for that. One of the things, again, that's a little bit of a drawdown, I guess, is that a lot of the times they're limited in their investment strategies. So, a lot like maybe a 401k, each state has a specific 529. And there are some states that piggyback on other states. For example, the state of Wyoming doesn't have their own 529, but they also use Colorado's 529. And obviously, they don't get the tax benefit because it's not in Colorado, but you can use other states' 529s. If you like an investment versus another, you can look at going to another state. But if you do that, you lose that state privilege or the state income tax benefit that you might get if you use your own 529 within your own geographic borders of the state that you live in. So that's one downside. In investment strategies, they aren't quite as open. You can't buy individual stocks for the most part. It is a little bit more limited, and there are some oversights there. But what I've found is that Colorado specifically has a great 529. They use Vanguard funds through a company. At least there's a couple of different ways that you can do that, but one specifically is called Direct Portfolio. Really great place to start. Low cost, all of the things that you're looking for as a nice savings vehicle and hopefully as an investment vehicle as well. Again, one of the downsides is that while on the plus side, it can be earmarked for college, the downside can also be that it can only be used for education expenses. If your child doesn't end up going to college or they don't need those funds, they get a scholarship, which I oftentimes see that parents have a tendency to over index on and have a little bit more confidence about their child getting a scholarship, when in reality, it's really about a 1% shot that a lot of kids get the full ride scholarship, either that's academic, athletic, or some of the others. So again, really great opportunities within the 529 space, but again, doing it with the thought process in mind, intentionality, being mindful of how you're doing it. Great way to do it. Great way to set your children up for success. Another cool wrinkle that this is a really cool thing that's just relatively new is that 529 funds can be rolled into a Roth IRA if all of them are not used. So that's another awesome opportunity within the 529 space. You can actually then set your children up for success when it comes to using those funds, or if they aren't all used, you can actually roll that into a retirement account. And so you get that Roth benefit straight away. So that's a nice deal. There are some limits to that, but generally speaking, a nice little benefit on the back end as well. Another way that you can set yourself up, your children up for success financially, is using a permanent life insurance policy. It's not one of the biggest things that I see. I oftentimes see the UGMAs and the 529s being kind of the primary tools, but a permanent life insurance policy can be a really great way to do this. This differs from a term policy because a term policy is just for a specific period of time. You don't grow what's called cash value. That's the real differentiator here. So with a child, if you take a life insurance policy out on that child, you pay premiums. And if it's a permanent policy, those premiums, part of them go to pay a death benefit and part of them go to build a cash value. And those can come through the use of a whole life policy or a universal life policy, or IUL or UL, and that can be index universal life or whole life, some form like that. And with that, that cash value can grow. The beauty there is that the cash value can then be used to take distributions on later down the road. This can be an awesome benefit for college savings. It can be used for a down payment for a house. It can be used for a lot of things. And because you're borrowing against the cash value, those dollars actually can come out tax free. Now, they end up becoming a loan. So if you've heard bank on yourself, this is how this kind of works, but it can be a great deal. So you grow that cash value. The nice thing about having children going through the underwriting process from a life insurance standpoint is that life insurance is very cheap for a young child. If you look at it from the actuarial tables, they have a long longevity of life, so their morbidity rates are very low and their likelihood of death is very low. So the actuarial tables suggest that their premiums are very low with that. And that's something that a child could have for a very significant period of time, permanent life insurance. You own the policy, so it could be something that you could have forever. Another nice benefit is if you structure it correctly, the premiums that you're paying, typically either annually or monthly or however you structure it, can be relatively flexible, especially after the first several years. The cons or the downsides to permanent life insurance is what of liquidity. So while you've been building this thing up, the liquidity on that is somewhat more challenging because in those early years, your cash value just doesn't grow quite as much as you'd like to hope. Whereas like with an UGMA or a 529, you can kind of see that first dollar, the expense load on that isn't quite as high for obvious reasons, because with a life insurance policy, while it is cheap, you are paying for life insurance at some level, and there are going to be some other costs that are associated. So sometimes it can be a little bit more expensive. But if you have the right approach, if you use the right strategy, if you structure it the right way, you can create a really strong policy that could potentially set you up for success or set your children up for success. Again, another thing that can affect this is that it could potentially affect financial aid eligibility because it is an asset of the child. So that's certainly something that I've seen as well. And also the growth potential on some of these can be a little muted. So if you're looking for growth's sake, maybe not the best place, you might look at something as an alternative. If you do it strategically with the right mindset, you can invest those dollars and they can be beneficial. But sometimes it's a little muted as far as your opportunity for growth. But it is going to be case by case, and it does matter what type of policy that you're putting in place. So that's certainly something to think about. But it does provide that policy. And I would say that you don't really want to think about this, but it would provide a death benefit if your child did die during the ownership of that. So again, just something from a safety net perspective, that's the worst of the worst that you could absolutely see, but that certainly is a potential benefit there. Another one is a Roth IRA for kids. Now, the caveat here is that they have to have earned income. And as business owners, one of the things that I've seen in the past is that you actually hire your child to do some relatively menial tasks, but they've got to actually have some value. I did this as a young kid working at a bank. You can actually be employed doing some tasks, shredding paper or cleaning up in an office or something like that. So a lot of times my entrepreneurial clients will actually hire their children, give them some sort of an income, then they can take that income and actually put it directly into a Roth IRA. The nice thing here is that Roths are tremendous vehicles for tax-free growth. Again, really flexible in how they can be invested. So you can really start that growth engine early. And if you do it every year, you can actually start to build that compounding wealth. And you can use, in some instances, a Roth IRA for educational expenses. But there are going to be some limitations and some exceptions to that withdrawal. So you've got to be careful about how you structure it and how you're really using it. But again, once that child turns 18, then those dollars become theirs. They can really use the savings vehicle there. So great vehicle there for setting your children up for success. Another downside to that is that you'd have to have earned income. You'd have to wait a long time to access those funds. And so sometimes that can be a little bit of a challenge. Also, with those IRA contributions, the Roth contributions, you do have caps on how much you can put in there. So that's certainly going to be something that you've got to contend with. But in some cases, what I see is that clients are kind of hitting all of these. They might do a UGMA, they might do a 529, and they might also do the Roth. So it's kind of also creating a little bit of diversification. That's certainly something that I've seen. The last bit that I want to talk about is not necessarily a specific account, but it's more of a structure. You can set your children up with success using trusts. So one of the things that we talk a lot about is within our community is making sure that you're doing legacy planning and estate planning. And those two things are going to be tied together. And if you have a trust for those children, you can really dictate the rules. So we talked about the UGMA that has certain stipulations where it becomes a child's at 21. 529s have to be specifically set up for the child for college or education expenses. Permanent life insurance has its own challenges. Roths have the limits. They have some of the. With a trust account, you can actually set that up. So to set up like a brokerage account, it'd be a trust account that would be the beneficiary for the children. You as a parent can be a trustee, and you can fund it however you really want. It can be for a lot of things. And the nice thing there is that you can actually set your children up with certain rules and expectations by way of the trust document. I have a client who his parents set up several different trusts for their children. So they have 4 children, and each child kind of had a little bit of different rules, which was really actually helpful. So when the parents passed away, the money became the children's. Now these children were adults, And a couple of them had kind of free reign, no strings attached. They could have that trust account, do whatever they needed to do for them. And then the other two had maybe some more restrictions. So that's certainly one approach as a parent. If you see your child maybe having some financial issues or potentially even substance abuse issues, and you don't really want to give them just the keys to the castle, so to speak, a trust account can be a great way to make sure that your children are set up for success by hitting certain milestones. For example, graduate college, you get X dollars or X percentage of the account. At 30, you can have another draw. At 35, 40, there's can be all these different lines that they have to hit if they do certain things that would prove that they are both responsible, they've done their homework, they've done some things to be responsible and actually take ownership of those dollars. So that's another way that a parent can set their children up for financial success down the road. With regard to some things that you can do as a parent, some habits that you can instill in your children, some tools that you can use. So, first off, is just setting up a basic savings account. So, this is one of the easiest things. And we kind of talk about some of the core financial tools for investing. But for a savings account, just having an account with that your child is on with you can be huge. I remember this as a young kid. My mom taught me how to balance a checkbook. She opened an account when I was like 1 year old. That was just a checking account. And then over time, she slowly taught me how to write a check, what that meant, what balancing a checkbook looked like, what having money that you earn from chores or money that you earn from an early job or the funds that you get from a birthday, from relatives, things like that. You can actually deposit that. You can see the balance, all of those things. What I kind of talked about earlier was more from an investment standpoint, but easy entry point is setting up a savings account for your children that you can then deposit gifts, allowances, things like that into that. What I really like about that is that, again, the kid can have that opportunity to understand, learn from that. There is some limited growth potential, but if you're just doing it for the sake of teaching, it can be a great vehicle. Another thing that I look at is in today's world that we didn't have as children is some of the tools that we have as adults. The technology out there is really cool that allows us as parents to have kind of oversight of our children's investments or their funds. Some of the things that I look at is understanding spending and budgeting skills. That's going to be a huge one. And you can tie that into different apps. There are also some really great books out there that can help guide the conversation around it because sometimes, especially 7-year-olds, they're getting really good at reading and there's some really great books out there that are kind of at that level. But things that I've learned just as a basic nature, and I'll get to the tech that we can look at or some of the books, but understanding and helping your children understand the need versus want battle. And this is something I talked about in the original blog, but I've had this conversation with my daughter, and now my younger daughter really is starting to come up, who's 5 years old. But over the last couple of years, my 7-year-old has become very aware of money. I think she started to learn this in school. So math, they learn about dollars, dimes, nickels, quarters, and that's part of their math understanding. So 4 quarters makes a dollar, things like that. And so we start to understand it, but that's also then tying it into our currency, which ties it into money, which ties it into how do you earn this money? Where does that come from? In fact, one of the things that my 7-year-old has been asking me recently is what our financial position is in life. So she asked me specifically if we are millionaires. And it's a little bit of an awkward conversation because there was a time when being a millionaire kind of meant something. I feel like over the last 5 or 6 years, the $1 million house has really lost its luster. Now it's a $2 million house or $3 million house. But my point of all of that is that you actually have to be able to navigate these somewhat awkward conversations, and you got to do it in a way that makes sense to the child. So again, this is where those books and some of the tech that you can bring into it can help bridge that gap a little bit, because sometimes it can be a bit of a challenge. So a lot of things that I've been working with my 2 older children on is understanding going through the store. What does that look like? So that's, again, a story that I brought up in the first blog that we don't necessarily need to dive too much into, but that's definitely a big part of it. Some books that I found that are pretty cool is Money Ninja. That's a really cool story. So something to share with your children. Another one is Rich Dad, Poor Dad for Teens. Again, this is probably not for the 7-year-old or the elementary school, although you could start to introduce that, but more for that middle school age, even high school age, and use some of the same tenets that you see in the Rich Dad, Poor Dad series, where it's building assets, not liabilities, thinking about cash flow, where does money come from? So starts to build that child's knowledge of money early on. Some apps that I really like is Greenlight. That's a cool kind of app that you can set your child up to, more of like a banking type of app. Go Henry is another one. Busy Kid is a really cool one because that's chores based. So you can really help your child understand the connection between chores. And so if you tell her that this chore is $3 to clean the toilets or what have you, in 3 days from now she'll be like, yeah, I you owe me $3. Well, the challenge there is that sometimes just in our day-to-day lives we don't have $3. So the Busy Kid can be a really great way, almost like a Venmo for that child. So cool way and kind of a cool opportunity to help your children with those chores, connecting the chores with actual payment. And it kind of puts the parents on the hook, and there no longer can be the excuse of, oh, I don't have the money. A little bit of a pro tip that I've done, and it goes to walking the stores, is just really identifying those money moments. You can set it up on a schedule, whether that's a monthly basis, weekly basis, but I think it's really cool to just think about it from the context of how do you buy something. And so we had a money moment recently with our family where we were buying a vehicle, and my 7-year-old really was curious about what that looked like. And so I walked her through the steps that we made, kind of talked about how we bought the car, what were we looking for, and why we bought this car versus that car. So it was a really great way to have that conversation. Another couple points here is, encouraging entrepreneurship. So my 7-year-old really wants to earn her own dollars. So I said, well, you come to me and tell me things that you want to do to earn money. So this is where she said, hey, what if I did X? What if I helped you clean up the yard? Great, that sounds awesome. That's worth X dollars. So it starts to her to really think about what value she's bringing and then connecting that to some sort of a financial transaction, but also things like mowing lawns. I'm not going to suggest a 7-year-old should be out there mowing lawns, but something as simple as the neighborhood lemonade stand or iced tea stand. This is something that my daughter's really interested in. And I think this year is going to be the summer that she does that, which is really cool. We're excited to set her up for success there. And then just understanding how it all works into the bigger picture, encouraging that entrepreneurship because it is a muscle. I think we all have it somewhere deep in our hearts. If we can set that up early on, that can be huge. Finally, kind of some takeaways that you as a parent can do is lead by example. Kids they're sponges. They see the world. They see what you're doing. And if you're financially stressed or talking about money in a negative way, that can have a huge impact. If you talk about money as in kind of a vanity standpoint, that can also have a huge impact. And if your child is, having these conversations around money, be open, be honest, be vulnerable in some cases. Now, I think that there's always some limits. There's some lines that you need to draw. They don't need to be your therapist. You don't necessarily need to share all your money woes. But I think if you lead by example and show them the positive side of how you spend money, what you do to earn that, and connect those things, I think that that's a really big thing. And just be, if you're telling your kids that they shouldn't be buying everything and every day you've got 4 or 5 Amazon boxes, that might be a little bit of a disconnect. And then also, one of the things I encourage, and this is something I have to talk to my clients about, is sometimes they just don't know where to start. So if your child wants to get the Barbie's dream house and they've got to save up 50, $60, it starts with one chore, one payment, one step at a time. So how do you pack the piggy bank, so to speak, with just that first dollar, that first quarter, whatever it looks like. And ultimately, if you want some guidance through this process, I work with a lot of my clients, help them help their children. We've had kids that are part of the conversations in the past, and I always invite that because if your children can be around it, then it's not foreign, it's not scary, it's something that they can talk with other people about, they can understand it, they can get interested themselves. And at 4 Points Wealth, we look at it from a family perspective that everybody in the family matters and that we really take that to heart because it's something that I deal with on a daily basis, helping my children with their financial questions and setting them up for financial success.